Good morning, everybody. Welcome. For those of you who haven't met me, I'm Jesse Iadanza. I'm the operations manager at Primex Title Agency. And on behalf of Primex, welcome to each one of you. And thanks to the panelists for coming as well. Before we start, I just wanted to say a couple words about Primex and who we are. We're a leading title insurance agency dedicated to providing exceptional service to our clients. Our team of experienced professionals has cultivated a strong reputation in the industry for delivering efficient and reliable title services. If you should have any questions about Primex, or if you think Primex can assist you in any way, please feel free to reach out to myself, Jay Oringer, Margaret Velez, or anybody else here from Primex now or after. We'll be floating around after this and after the next panel as well to acquaint ourselves with anybody else that would like to meet us. Now, it's my pleasure to introduce our moderator for today's panel, Mr. Michael Stoller. Mr. Stoller brings a wealth of knowledge and expertise as a prominent figure in the real estate industry here in New York and elsewhere. We are thrilled to have him here with us, and we extend our sincerest thanks to him and each of our panelists for joining and speaking today. So I'll pass this over to Mr. Stoller to begin the discussions with this group of experts who will share their insights on our first topic, the reinvention of office, retail, and industrial space.
Before we discuss anything, I'd like each one of the panelists to introduce themselves and tell you a little bit about themselves and their company. Let's start with Brian.
Okay, hi. So I'm Brian Steinwurtzel. I'm the co-CEO of GFP Real Estate. GFP is really two different companies. One is the legacy portfolio of the Grau family, 13 million square feet of owned office in New York City, along with another 6 million square feet that we manage for other families. We are the largest landlord to small and medium-sized businesses in New York City and have a focus, obviously, on tenants that are less than 10,000 square feet. The other side of the business is new development, a lot of very random projects that are usually large with private equity. Some examples are a life science building in Long Island City, Queens, the redevelopment of the Guardian Life headquarters into New York City Health and Hospitals headquarters, the development of the Securities and Exchange Commission's headquarters in New York City, and David Geffen Hall at Lincoln Center, just to name a few.
Morning, everybody. Thanks for joining us. My name is Joe Farkas. I'm the CEO and founder of Metropolitan Realty Associates. We're a New York-based investor and developer, and we really focus our time on the industrial sector and the retail sector, believe it or not. Haven't given up on retail yet. And invest and develop throughout the New York metropolitan area. We own several properties in Long Island City, on Long Island, in Connecticut, and we really aim to deliver outsized returns to our institutional investors through some sort of repositioning, redevelopment, or actually ground-up development.
Last but not least, Mike.
Morning, Michael Maturo. I'm president and founder of RXR Realty. We're centered here in New York City. We have about 20 million square feet of office, but we have a diversified portfolio on a national platform. We have residential storage, industrial properties around the country. We also do a lot of mixed-use projects. We are developing JetBlue's new terminal at JFK. It's a $4 billion project. We formerly ran a public company called Rexon. We sold that company in 2007 to SL Green for over $6 billion, and then reorganized ourselves as a privately financed, mostly institutional, high net worth investors, and been operating RXR for the last 15 years.
So I recently did a Stoller Report show, and I had a developer who's developing in 4 of the 5 boroughs. He said, I'd like to develop in Queens, but I can't find the right deal. His comment was, it's the best of times and it's the worst of times. So let's try to identify that with what your thoughts. How do you look at the market today? Are there opportunities out there, or is it just doom and gloom?
Well, I've been telling people I put my day consists of my offensive hat and my defensive hat. The problem is I'm on the field all day long, so I get tired by the end of the day. But it's a challenge.
Do you reach the field, the goal at least?
Well, every day you try to chop away a little bit more of the wood, but, you know, right now it's a challenging time, but there's opportunity. I mean, we also have a credit platform and due to the lack of liquidity in the marketplace, you know, there's opportunity to provide, gap capital, bridge capital, rescue capital, good news capital, whatever you want to call it. And we're doing that on the multifamily side, and then we're starting to see that on the office side. The office, obviously, we'll talk about, it's going through quite a revolution right now, and we'll see where that ultimately winds up. But there's going to be, I think, tremendous opportunity on the office side as we work through this cycle.
Joe?
Yeah, I'm a big believer in folks who know me, you know, I'm a grinder. I like to dig into the real estate. I think there's a lot of opportunity in effective management, and a big believer in making your own luck. Hard work really creates your own luck. And we've seen that during difficult times by effectively managing your own portfolio. You can really turn lemons into lemonade, and understanding the leases of your assets, the loan structures of your buildings, you know, you can ward off some bad times and bad situations by being on top of your business. With that said, there are opportunities, not so much that I see yet on the office side, and as Michael said, we'll get to that. But I think that the repositioning and redevelopment businesses is still viable in certain sectors, and we really see it at MRA in the industrial and the retail sectors. We're repositioning industrial assets where we used to redevelop them from an industrial building to we'll just call it an office building. We're now taking existing industrial buildings and just making them better, not building them particularly from the ground up, but we're going through site plans, planning review processes, and adding loading docks, raising roofs, doing all the things that I would say the majority of the industrial tenant base requires. It's not always about 36-foot clear roofs. It's about loading. It's about having efficient ceiling heights, anywhere from 18 to 24 to 28 foot. We don't need to go the full height all the time, and creating opportunities that way. And there's a fluid market of deals where you can go in, you can buy existing structures, take the time to go through site plan and make some money, because you know at the end of the day, you're leasing to a tenant pool that's more infinite than finite. So what I mean by that is there's only a handful of qualified credit tenants that might take a 4-story, multi-level, Class A out of the ground industrial building, but whereas a single-story industrial asset in Queens, the Bronx, Long Island, New Jersey, there's a plethora of tenants to lease to. So you really limit your downside and create the opportunity for some upside. That's what we're focused on right now.
Brian?
I think that's, you know, the best of times and worst of times is a good way to put it. Although I think so on the office side, on our legacy portfolio, when COVID started, we had 99% leased portfolio. Within 12 months, we were at 80%. Just a lot of small and medium-sized businesses were not able to survive the initial year of the pandemic. But then through PPP programs and then the restarting of the economy, we've seen our portfolio go from 80% leased to low to mid 90s. So there is a lot of leasing going on, at least for small and medium-sized businesses, which is not talked about very often in the press. The challenge is that the net effective rents are significantly lower, and the lease durations have shrunk significantly as well. So like average lease duration going from, let's say, 7 years in our portfolio to more like 3, 4, 5 years. And what's happened is that for us to be able to rent, we have to pre-build and even furnish most of our units. And that is very effective in causing tenants to come to our buildings and then to actually result in transactions. On the other side of the business, the new development business, you know, our project at 25 Water Street is the result of being able to buy a loan at a discount and also to make a deal with the equity to walk with something as opposed to nothing. And I think those kinds of transactions hopefully will come around more often. I'm not sure if it'll be office to residential conversions, but I do believe that there will be lenders and owners that will have to transact, and that will result in groups like us hopefully being able to take advantage and do some deals that we'll be extremely happy about in the future.
Yeah, I think just picking up on that point, if I may, Adam.
Sure.
Something. I think that being flexible and taking some risk in terms of asking for things you may not otherwise have thought you could get, maybe a rezoning or putting a different use into a building that you otherwise thought would be a retail building. It's an industrial building now, or was a retail building and it's a self-storage building today. I think by putting yourself out there and looking for change and stepping out of the comfort zone, so to speak, there's a lot more acceptance from governments and local officials to creating new zoning changes and giving developers and lenders the ability to work themselves out of otherwise bad situations. Nobody likes to see a vacant building anywhere in your hometown or in Manhattan. It's,
You know, with regard to repositioning of office buildings, you know, when we had the crisis in Lower Manhattan a number of years ago, we had the 421Gs, which offered you the opportunity of a tax benefit. Right now, I don't see these 421Gs. I mean, you're on one Water Street, then you have Von Burton on another portion of Water Street. Looks like Water Street's becoming from office to residential. But how do you do a conversion if you don't have the government support to lower your taxes and so on?
And so as far as conversions go, there's three ingredients. So one is it has to be as of right. And unfortunately, most of New York City is not as of right residential. The second is that you have to have a path for the building to be vacant, at least in our opinion. It's very, very difficult to convert a building when there's tenants in between or on top. And then the third is having a low basis, you know, which is really the primary issue. If it's cheap enough, usually you sort of figure out a way to do it. So without government intervention, you really need all three of those things to line up in a perfect way. And that's really what happened downtown with 25 Water. I think the government programs that were floated during the last budget process had there's a lot of room for success in those. I think, unfortunately, the legislature and the governor cannot get along, and even the city, the legislature and the governor could not get along because a lot of those programs require the government to pay for some element of the development, whether it's by giving up property tax revenue or by providing actual revenue or some other element. And it's difficult for the city that is trying to balance its budget or a state that's trying to balance its budget to actually float those kinds of dollars. So someone has to pay for it to work if we want the government to intervene and that if we want affordable housing. And unfortunately, if they are not, I'm certain that the private developer will not be paying for it. So
Let's look at it in a different manner. When you convert an office building to residential, the square footage of the building decreases. You're not getting the loss factor, the extra 20%. How do you look at it there?
yeah, it's all in dollars at the end of the day, right? A lot of us are office people, so we talk in this square footage and it's really an inflated square footage. But at the end of the day, when you're developing a residential product, it really is just what's the gross square footage and what can you net on a residential rentable basis. So it's interesting at our project, that building was measured as a 1.1 million square foot office building. Really the gross square footage is more around 900,000 square feet. And we're able to achieve roughly 800,000 square feet of rentable space out of it. So you can take these larger buildings and make them very efficient. It just takes a lot of money to do it and a lot of creativity, especially on 25 Water, creating two large light wells and then taking that square footage and putting it on top of the building.
You know, when you made your introduction, you mentioned that you did the conversion in Long Island City. A couple of years ago, everybody was looking to convert their industrial building in Long Island City and Brooklyn and certain parts of the Bronx to convert it into office. Now, in most cases, I mean, you got a good tenant for your property, but in many cases, you have vacant buildings over there because nobody wants to be in the office market. I mean, Joe, you know it well because you know Long Island City.
Yeah.
What's going to happen to those buildings?
It's a great question. We initially bought in Long Island City because we just simply liked the opportunities to buy great industrial buildings with, you know, tremendous window lines, heavy floor loads, lots of loading, very very leasable assets. Even though they were multi-level assets, every building we looked at was very leasable to a wide variety of tenants, limiting our downside. And we never really thought about the office component and didn't get dragged into that conversion. When I look around and there's several see-through buildings, I really look at them and just say at some point in time, the basis that a developer can buy that asset for in the near term, when a bank finally lets it go, will be an attractive basis to convert it back. Now, that sounds terrible. It's horrible to think that that amount of equity that I know has been put into a lot of these see-through buildings could be burned. But truthfully, in the near term, there are no office tenants to pick up hundreds and millions of square feet that are sitting in the boroughs vacant. So we're sitting back, we're watching those opportunities, and we think one day they'll convert back, but they'll be converted in different ways. They'll be converted to industrial using ramping. They'll be converted adding freight elevators. You won't see the mammoth out of the ground multi-level buildings, but you'll see these buildings redeveloped so that more loft style industrial tenants can occupy them. The 10,000 to 30,000 square foot user is a prime user in the boroughs for flex industrial. And we like that business. We've done well with it. And are going to keep pursuing those opportunities in the boroughs.
Mike, have you done any of the conversions, from industrial to office?
Well, historically, we did a lot of that.
Right.
Out in the suburbs. We haven't done that recently. On the conversion side, I think stepping back and talking from a high level on this conversion concept, it's interesting in terms of, I think everybody's looking at it as a potential savior for what's going on in the marketplace. But I think just like we've gotten in this situation on an accelerated basis as a result of the interest rate spikes has just changed the math for real estate dramatically. Conversions and the notion of obsolescence has always been in the marketplace. I mean, Joe, Brian, we have done conversions over the course of our careers, but now everybody's looking as a solution to potentially convert 200 million square feet of potentially obsolete office space into something other than office, maybe residential. It's not easy to do. It's very complicated.
You also have to buy out the tenants.
There's tenants, there's zoning, there's the floor area ratio issues. It's whether the physical nature of the building can suffice. So it's to think that we're going to go into this massive conversion sequence. I think that's probably foolish to think we can do that, but it will happen, and there will be opportunity. We bought the White Plains Mall in downtown White Plains, and it was a vacant mall. So
It didn't have to worry about tenants. There were no list.
there is no tenants there. There is, we had to go through a zoning, but it was done quickly because the town didn't want an eyesore in the middle of the downtown, and we got the upzoning for residential, and we're building 450 residential units a block from the train station. I mean, that's taking obsolescence and doing conversion into a better use, and that's going to work. We're working on another mall in Long Island, but it's half vacant. It's not zoned for residential. It's got 4 tenants in, and that's going to be a long-term thing. And whether you put the time in or not, that's up to how you want to approach your business. But the conversion concept has always been there. It's something that developers can create value, make money with. But the notion that it's going to be the savior of the real estate problems that we have, I think is off-minded, and I think we have to think better about that.
Joe, I think let's talk about your conversion, in Nanuet, because that's a good example of it happened before, the interest rate rises, but it's a great example.
Sure, it's not dissimilar to what Michael's speaking about. We bought a former department store, a big hulking asset that we thought we'd be in a great position to release, even with kind of the headwinds beginning against retail. We felt our basis was very strong. We were adjacent to a major outdoor lifestyle Simon property mall, which was beautiful and very well leased. So we went into it with eyes wide open and a tenant in tow, but didn't ever consider what was going to happen with COVID. It was a very interesting time. We had gut renovated the building. We had pretty much 90% delivered our first floor of the project. It was a 2-floor department store, and the tenant, I don't know why they did it, but they actually, during COVID, accepted the space when I really felt like we were all done there. I didn't think they were a savior, but they took the space. And we were left with a second floor of retail that just seemed at the time unleasable. Anything we did during COVID was.
Couldn't put a gym?
Nah, well, no gyms. Nobody went to the gym during COVID. So we approached the town, and I kind of made this statement earlier, as we've done on many projects where we're either rezoning or redeveloping. And we talked to them about creating a mini warehouse self-storage zone within a regional shopping mall district. And the town supervisor, who was terrified of his tax base just evaporating during COVID, basically just rubber stamped everything. And I had to go back and deal with the partners at Simon Properties and get them to bless that use, which was not part of the REA at the time. And looking at an REA that's this big and trying to wiggle in one use of self-storage seemed like a daunting task, but they accepted it, which was unbelievable. And we redeveloped that, it's like 125,000 foot floor into a self-storage property. And that really saved the day. That was the icing on the cake to carry the building's value over the mortgage and our equity in the deal. And today we're about to, begin our leasing there, and really a great project, which we then condoed, and we're gonna ultimately sell off the 2 units separately for some efficiency in pricing. A self-storage guy doesn't want a retail piece, and a retail guy doesn't necessarily want a self-storage piece. And so I think that was a very smart way to handle a difficult situation coming out of COVID. And I think that also goes to being nimble and creating your own luck and doing hard work. That even Mike said, do you want to run your business that way? I did not want to run my business that way, but I did not want a failure. So we dug in and really, credit to my team, supported the effort, and that's going to be a great, successful project. So I think that encompasses a lot of the things that we try to do at MRA.
Brian, with such a large portfolio of older buildings, okay, what do you see happening to them? As you said before, you were at 96% occupancy, you're at 80% occupancy. You went down as low as 80%, you may be higher today. What do you plan to do on a repositioning of those buildings, or what's the best use for that?
I mean, for the majority of our portfolio, the highest and best use probably is what it is today, is office. We've always reinvested in our portfolio. It's something that even if the building was 100% rented, if the lobby needed to be redone, we still went ahead and made that investment because we knew that it would pay off in the future. So most of our buildings are best in class when compared to their peers. And I think that's why we stay leased. I think what will happen with buildings that are struggling is either the capital stack will get rationalized, which will either have the existing owners put in more equity, or the lenders take a discount, or some sort of a sale process that'll make further investment make sense. Or I think over time, I do believe in government. I know it's difficult to say that, especially given what we see every day in the paper, but there's, we haven't talked a lot about it. We talked a little bit about it. There's a huge demand for residential apartments here in New York City and the surrounding area. And one thing COVID showed us is that even, I guess amidst the pandemic and certainly after it, that people want to be here, and they want to be here in droves, and we don't have enough housing stock. And I do think that eventually government will get their head around it and figure out how to get the area zoned, put the right incentives in place. And I think that a lot of these buildings can become development sites or repositionings. I'm not sure office to residential conversion. I wouldn't spend a lot of my time betting on that particular one, but I think that that will happen, like these areas of Long Island City, certainly a lot of areas of Manhattan, you know, Brooklyn certainly has shown almost all the residential projects that have gone in there have been successful. I think that will really be one of the future elements of real estate development as these multifamily projects.
You know, healthcare has become the largest industry in New York in many aspects. Do you see, I mean, Mike, for you to talk about your own buildings and Brian to talk about his buildings, do you see any of the healthcare companies like NYU, Mount Sinai, you know, Northwell, coming into taking over buildings completely? Because I know that HSS and Memorial Sloan in the suburbs have been very active in moving. Do you see it in New York City, you know, in Brooklyn and Queens?
Yeah, it's actually been happening. I mean, what the healthcare and the hospitals are doing is they're moving administration out of their facilities, so they have more more available space for patient care.
Right.
And they're moving space. They've moved a tremendous amount of space into the Manhattan market, and you know, we see it out in the suburbs too on Long Island. So I don't think there's another wave of that happening in a big way. But over the last 4 or 5 years, they have taken a lot of space in Class A buildings.
Right, but they've taken space for administration, but they've also taken space for ambulatory care and urgent care. I mean, NYU on 38th Street has one building, you know, half of the building is half Verizon and NYU. On 41st Street, they took that office building that Stanley Stahl built between 2nd and 3rd Avenue, and the entire building is ambulatory. People aren't being put into the hospital. Can't you? I can see that very possible for your larger buildings.
You know, we're seeing a lot of that in the suburbs. I think you probably can see some, you know, ambulatory care in buildings, particularly maybe using for some of the retail spaces. We've actually had a couple of our buildings in Chelsea have had interest for exactly that purpose. So I think you'll see it. I don't know if it's going to be a solution in terms of absorbing space, but yeah, certainly healthcare has been a big user and expander of space in the city, in the boroughs, and you know, in the suburbs.
You know, Joe brought up the subject of retail. How do you look at retail today? I don't see it as doom and gloom. I think there are opportunities for retail in different aspects.
We definitely believe that. I just want to touch on one thing before we get to retail. Really agreeing with Brian. What we've seen outside of the city is the government intervention in bad situations, and there's not enough medical use that could ever fill the hundreds of millions of square feet that might be in trouble in the office space world of New York. And unless the government really steps in and makes a zoning change or gives subsidies to developers to convert these buildings, or basically knock them down, forget even the conversion, just knock them down and rebuild them, you'll never solve the housing.
It's like the White Plains Mall.
Yeah, so whatever it takes, the government has to get involved, and we can sit back, and it might take 5 years till somebody wakes up and does that. But that's what really needs to happen in New York. And the sooner that it happens, the better for everybody, because it's not going to change, you know, just sitting around. But with that said, we do like the retail business a lot. And we're trying to use our knowledge of zoning and the marketplace in the boroughs to bring grocery anchored tenants into these multi-level buildings. So where we spoke about converting one of these see-through glass office conversions back to industrial, the other thing that we're looking at is some of these older multi-level industrial buildings, and using zoning laws to bring retail and grocery stores into the boroughs where there's not as much full service grocery tenants, and there's a tremendous amount of demand from really the credit users for these spaces. And it's a lot about finding the right buildings, understanding New York City zoning code, And I think that's going to be a backdrop for a lot of these, not hulking, huge 400,000 foot deals, but the 50 to 70,000 footers is a great opportunity to look and try and bring retail back to the boroughs, and then build on that. If you can bring a grocer to Long Island City or to the Bronx, where they really need grocery stores, and then build out your tenant base. It's a very successful theme, and we were very successful in doing that in the Bronx in the former Stoladora Cookie Factory, where we knocked it down on a 5.5 acre site, built a 124,000 square foot BJ's Wholesale Club below grade to get around the zoning code, and then built a 70,000 square foot freestanding retail center with 10,000 foot stores to all the nationals that wanted to get into the boroughs. Highly successful deal. That's a great spot, Michael, where we really want to come back and recreate something.
Or aren't you doing something, another bakery, you said?
Yes, we are similar but different. We purchased a bakery on Long Island, a 12-acre site. We're going to knock down that bakery and build ground up warehouse distribution, which we think is in a location that we think is great. And we're going after cold storage users, freezer and refrigeration, because that's another niche play in the market where there's so much demand and really built up from the COVID era, so to speak, and not enough product on the market. So little niche play, but we like that business a lot. We can get paid for the development. We have a good basis in the land below what we think market is, and we're going through, our site plan process. We've already been rezoned. The town was great, and I'm saying a lot of same themes, but it's kind of how things are going, and it's been working.
I think one of the items that is coming out of here is it's government-friendly approach.
Yes,
Especially
100%.
Mike, I think what New Rochelle and other parts of Westchester have done. Let's talk about what you've done over there with a friendly government and you as the master developer.
Yeah, we formed a public-private partnership with the town of New Rochelle, and basically, what they did is they saw a vision for their own downtown and how they can revitalize and redevelop. And they were very aggressive working with us to develop an overlay zoning that not only us in terms of development were able to take advantage of, but many other developers. So if you go to New Rochelle downtown, there's 7 or 8 projects and 6 or 7 different developers. So it's been a highly successful undertaking by the mayor there, by the city council, and by the head of economic development to partner with developers and upzone their downtowns. We're on our 3rd project there on the residential side. We have 2 fully leased towers, and our third building is under construction, and we expect to start leasing later this summer in the fall. And it's been very successful. And the good news is you're seeing that format replicated in other areas around New York City, and it's one solution for providing I'll call it affordable housing relative to what you have to pay in New York City and in the boroughs. That can't be built in New York City. And, obviously we've been doing it along the transit lines. As you mentioned, we're doing a development in White Plains, a 30-minute commute. We did the same thing in Yonkers and Stanford. We're doing it out in Glen Cove on Long Island. And there's other places, Mineola, Patchogue, places like Harrison, and there's other places around the tri-state area where government is finally stepping in and realizing that they need to be cooperative. They need to get zoning approvals and permitting done on a more expedited basis. It's still not to a level and in a time frame that I think you need, it's still, but it's starting to accelerate. So I think that's good news. And it was, prior to the pandemic and prior to the significant increase in the cost of capital, there was tremendous momentum in these types of developments. And hopefully we'll get through this interest rate cycle and get more liquidity in the market, and you'll continue to see that happen.
So when we're talking about capital, all these things need money, which is going to be the next panel, a little while, money for real estate. What are the banks doing today, especially with the recent failures taking over there? How are the banks reacting when you come to them and say, maybe I'd like to convert this, or I have a potential tenant who could move into the space, but I need to give them, I have to build $125, $150 for TI. Can you lend it to me? Are the banks being receptive, or are they just sitting and waiting to make a decision? Even though we'll hear from them next.
Construction money is very difficult to come by, and construction money costs 8% or more. So first, to underwrite and pencil out projects with the cost of capital where it is extremely difficult. The banks themselves are dealing with massive issues. You're starting to hear about it. They're not generally lending, and I think the liquidity in the marketplace is completely dried up. So again, going back to conversions and the ability to get projects done and solve this problem, the liquidity in the marketplace is not there, certainly from the banks. Now, there is money from funds and other third-party lender sources that's starting to come into the system, but it's extremely expensive. And generally speaking, it's hard to pencil out transactions. So, I would say you're in a pretty much of a logjam in terms of moving in a big way these types of projects going forward. I mean, guys, I don't know if you've seen anything different, but
We've been successful in our business with lending institutions that we have longstanding relationships with. I think it's definitely a price point issue. Doing $300 million loans is much different than doing a $30 million loan, right? And I think there's definitely more liquidity for that type of loan. I think the sponsor equity partnership brings a lot to the table when developing lending relationships, and lenders look at that seriously. And if they like that relationship, if it's a long-term relationship versus a brand new, hey, we're going to try something out, I think long-standing wins every day. And I think that everything is project by project. I've never heard a lender tell me in the worst of times that if I had a building and I had a tenant that I was bringing together to develop, no, we don't want to do that deal. Some might say no, but there was always a lender that saw the opportunity. And so I think, not that I'm disagreeing with Michael, because he's correct. There's definitely been an enormous slowdown in lending activity, and more to that point, the time in which it takes to get loans completed, the process within the banks that's been drawn out to really do their diligence. But there's definitely opportunity. Now, with that said, interest rates, to do a multi-tenant industrial deal with, typical WALT of 5 years or more, rates are at 8 to 10%. Is that great? That's not great when you used to be able to borrow at 3% or 5%. So it's made pricing to buy deals more difficult because that gap has to come together. But if you have existing product that you bought before interest rates spiked and you had a good basis in your deal and you did some work to your property to improve value, you can go out and get a loan today, 100%. You just have to have good piece of real estate, some good cash flow, and tell a good story. And you can finance in a market where it's otherwise.
the problem, though, is that when you look at what your equity cost of capital is, right? that, and you apply the debt cost of capital to it, it's very hard to make that all work. Right? So, yeah, you can have a good project and maybe you can get financing, but does the whole thing work out? Because then nobody really knows where valuation is right now. So nobody really knows where exit cap rates are. So the whole equation has become extremely difficult in terms of finding the debt capital, the equity capital that will really underwrite a project that they'll contribute a capital to.
Brian?
Yeah, I think, look, I think if you have a good tenant and a good building, you'll probably be able to figure out a way to pencil it. But overall, I think that Mike is right. Strip up the feedback.
Okay.
Try again. So I think that Mike is right in the way that the capital stack is right now, very, very difficult to make sense. Like the equity returns, given the cost of debt as it's sliced all the way up the chain is probably like in the low to mid 20%. So if you can't pencil a deal, if you can't look at your equity and say that you're going to get a low to mid 20 IRR and at least a 2x multiple, like it's probably difficult to get a project signed off and done right now. But I think that is today. And, you know, a lot of the projects that we're looking at, I'm sure that these guys are looking at are probably down the road and ones that we're trying to put into the pipeline. And I think that everyone from government to private equity to public banks are all incentivized to try to figure out how to rationalize what's happening. I think it will take time to sort of get through this, but I do think it will get rationalized. And I think that we need as a society to be able to do deals. And when we know that we all need to do that, we will all figure out how to make it happen. It just
It's
takes
a society issue. Yeah.
it absolutely is. We are a population that is growing, right? We do generally want.
I love that. I mean, I love
That's-
it's a society issue to do deals.
It is. I mean, we need to build schools. We need to build housing. I mean, unless we decide that we're going to be a Chinese culture where there's only one child, we are going to grow as a population. And if we're going to grow as a population, we need all of the things that people need. And we are people. We need to live. We need to eat. We need to, you know, do all the things that we do every day. And in order to do that, we need people like us to actually build the things that people use. And so I think it does get resolved. And I think that'll just in a matter of time. And for all of us, there's probably a lot of opportunity in this dislocation. And so, you know, just being patient and being able to sort of pick your spots, I think that will benefit in the long run.
Right. And I do agree with that comment, laughing a little bit, but the good times are ahead. There's going to be a correction in the market. And I tell my team, you know, we're underwriting every day. We're an underwriting shop. We search for deals. We're always evaluating the market, whether it be from a rental standpoint, what are tenants willing to pay, who's looking for deals in the market, to what's available for sale. Understanding those three equations when the time is right and you've been in the market and you can prove out to your equity partners and your lenders that it's the right deal to buy, floodgates will open. So it's not a time to go and sit in your apartment and hang out. It's a time to really be in the office and grind away and find the opportunities, because nobody's going to bring you a deal and put it on your plate. You really have to do the work to get things done.
So I think in conclusion, the audience and I have received great information from the three of you talking about the world today and the repositioning and the opportunities. And I'd like to thank Brian, Joe, and Mike. And we'll be back in about 15 minutes with the next panel.
All right, thank you, everybody. I hope you enjoyed the first panel. I certainly learned a lot about the redevelopment of properties here. We're going to get started on our second panel, money for real estate, real shortly. Again, just want to thank everyone for coming. Thank our panelists and Michael Stoller again. Again, Primex Title Agency, if you think we can help you or give you any assistance with any real estate transactions, feel free to reach out to me at any point in time. Again, Michael Stoller here with second topic, money for real estate. Take it away.
So let each one of our group introduce themselves. Danny, and we're doing this. You're Dan and you're Danny.
Okay, that works. My name's Dan Harris. I'm the Chief Commercial Real Estate Officer and New York Regional President for OceanFirst Bank. We're a New Jersey bank. We're about $13 billion in assets.
Hi, my name is Laura Greenfield. I run the New York Commercial Real Estate Lending Group for IDB Bank. We're headquartered in New York City, and we're also about a $13 billion bank.
Daniel Ridloff, Managing Director, and I run credit at SLATE Property Group here in New York.
Is it SLATE or is it Scale?
Scale is the lending subsidiary of SLATE.
So you run the alternative lending
Correct.
platform.
Exactly.
So, is there money for real estate? Okay, we heard the repositioning, we heard this discussion. You read in the regs that the world is coming to an end. Is there money available? Let's start with Dan.
There's money available.
Oh, hold on. Could you adjust the volume so we don't hear the pings?
Thanks. There is money for real estate for banks. On the banking side, I'll speak to for existing customers with full relationships. I think what's going on in the industry is unique, and I've been through a few credit cycles. This isn't so much a credit cycle as it's a liquidity cycle, in that with what's going on in banking recently, especially since March, where deposits have flowed to the government, deposits have flowed to money center banks from small regional banks that our size would people call us. It's been much more challenging, and you need deposits to make loans. So for those of us that have been impacted, and we haven't been impacted that much, but there's been a much bigger focus on banks, loan to deposit ratio, how many of you depositors are over $250,000, uninsured depositors, those metrics that only investors used to care about, now everyone seems to care about. So, and in the Northeast, a lot of the banks do ride at a little higher loan to deposit ratios. So we're all just being cautious with our powder, and we're pretty much focused, I can speak for mine, we're focused on our current customers with deposit and full relationships. We're taking care of them. And to the extent we, look to brand new deals, they're a little more challenging unless they're deposit rich.
Laura?
So there's absolutely less liquidity in the market, but for banks like ours that have the liquidity and have the capital, we are certainly lending. And actually, we're taking this opportunity to take advantage of the market and even onboard top superior sponsors, and of course, take care of our existing clients. We're focusing on industrial bridge construction. We're focusing on multifamily lending, market rate, mostly construction, bridge, permanent. And this is the first time actually in a very long time that we can be competitive on market rate, multifamily cash flowing deals. We're focused on certain types of retail, and we're focused on even some hospitality.
Yeah, so for what we do, there's definitely some liquidity in the marketplace. It looks a lot different than it did a year ago. It's actually very resemblance of second half of 2020, 2021 coming out of COVID, where there was just a complete illiquidity in the marketplace. So it looks a lot different, but it's definitely there from us for the right project.
So, Laura, you were just saying that you're lending on multifamily. Right now, the rent increases are projected maybe 8% or so on for a 2-year lease, and maybe a 5% for a 1-year lease. Expenses are going up much greater than that. How do you evaluate the market? I mean, I don't believe Signature had a significant number of bad loans in their portfolio, but they had a large portion over there. So why are you going right now into the multifamily, the existing rent regulated and rent stabilized?
So we're not focused on the rent regulated, rent stabilized part of multifamily. We're focused on market rate. We still think there's a lack of supply. And so there's great demand in New York City still for multifamily. But to your point, you're right, we have to underwrite carefully. And so we're underwriting to certain debt yields. It's not just about debt service coverage ratios.
To give the audience some information, what kind of debt yields are you looking at? I'd like, to focus on where the pricing is, so somebody gets a good idea of the market and what they'll come to you when they have a deal.
Absolutely. So we're focused on, I would say, in the 9% debt yield range, right? 9 to 9.5.
And it used to be what?
7, 7.5.
Right.
So, I mean, that's just a function of our base rates rising, frankly, and obviously a little bit of spread rising as well.
So we focus a lot more on the ground up construction space, and we used to size deals to a 6 to 7. We're now sizing to 7 to 8 and even higher. And again, a lot of function of that is our takeout. When your takeout was 3% a year or two ago, it could size to take you out. When your
So what are you,
takeout
what are
was
you
based on
projecting?
6%.
What do you, so you take out, what are you projecting it on? 6%?
There's debt service coverage, loan to
Right.
value, but when your interest rates are double what they were a year ago, everything has to shift accordingly.
Laura, no, Danny brought up the subject of hospitality. Let's talk about hospitality for the financing market.
I've got nothing to say.
I,
about
I can take that. For us, for premier sponsors with cash flowing, lowly leveraged hotels that are,
Limited service or a combination?
could be a combination, and we still have room. So again, we're so relationship focused that to us, our clients,
What about, in that caveat, what about recourse?
absolutely, there's recourse.
The world has changed. It used to be.
The world has changed.
So that's changed.
Everybody's on a recourse basis today?
For hospitality,
For
No, hospitality and,
hospitality, yeah,
right.
you do it.
So do you like limited service or do you?
it depends. Again, I wouldn't say we're going heavy on hospitality, but we still have room and availability to lend to that specific asset class, for the right sponsor, for the right specific hotel.
Dan?
Yeah, well, I mean, we have some hospitality in our book. We're certainly not looking to expand right now, even though the hospitality market has come back extraordinarily strongly. There's no question about that. What's happened the last few years, they're much better positioned than they had been. It's just not something we're looking to add to our portfolio. You know, unfortunately, the entire commercial real estate market's been hit with the same brush, you know, with central business district office. So, you know, it's challenging for all of us in the banking world to go long on CRE generally because people don't distinguish between office, which is problematic, as we all know, for obvious reasons, and industrial, which, you know, they were talking in the earlier group, you know, industrial is still pretty strong, especially last mile, you know, grocery anchored centers are still strong, strip centers on Long Island. There's still a lot of very strong real estate out there that needs financing, and you can get it now with decent leverage, unless it's rolling from over leveraged position, and you can get much better coupons than you used to get. So there are a lot of opportunities out there right now because there aren't that many people lending. So the opportunities, we see deals that are brand new to us, and it's very challenging because they're extraordinarily strong, but there's no deposit relationship, there's no pre-existing relationship, so it's challenging. We really want to make sure we take care of the people we've already worked with and make sure we have powder for them when they come in for those type of deals.
Well, yes, Laura.
In these times is when we make our best loans.
Yeah.
You
It
should
does.
make your best loans.
Because the dynamic, right, the credit side is awesome right now. The next loan you do is going to be some of the strongest loans you ever do because of where we are perception wise. And, you know, everyone's getting tighter. I mean, people are writing a 7.5%, 8% takeout rate, you know, which is about a 9.5% constant. So, you know, you need a significant debt yield to get to your 125 DSCR. So deals now are really good. The issue that we have today is so different in that it's you know, you have liquidity, we have liquidity, but we don't have as much as we used to have. You know, branches used to bring in the deposits for banks, community banks and larger community banks, which is really what we are. And, you know, we have 40 branches and they do great, but that was always your source of liquidity. We never had to worry about it. Now we all have to worry about it. We have to make sure our relationships are deposit rich and make sure we give the good coupons at our branches to make sure the money keeps coming in.
So here's the big question. How has your credit committees changed, or your underwriting has changed during the period of time? I hear the rates, I hear the yields and that, but how are the credit committee making a decision? Is it easier to say no or yes?
There's much more aggressive stress testing on the takeout than there used to be. I mean, we used to, you know, if it works now, it'll probably work in 5 or 7 or 10 years when the thing matures because inflation is going to move parallel with interest rates conceptually. Now, you might lend it, just pick a number 6.5, and you're going to stress it for 7.5 or 8 with conservative income growth assumptions and more painful interest rate assumptions to make sure you can get taken out at maturity. That was always kind of there, but now it's 2 pages of every credit write-up.
Laura?
Well, for us, I think at IDB, we've always had a conservative or a good approach to credit.
For
And
the many
so-
years that I know them, they were always conservative.
Yes. So when you think about, well, what has changed, I actually think we're continuing to do that good job of conservative credit structuring. But we're starting to get added credit enhancements that we
Such
couldn't have
as?
gotten. So as an example, a retail deal where maybe you would have had springing master lease. Now it's springing recourse, principal recourse. So clients would have really fought that before. Now they aren't fighting that.
Danny?
Look, thankfully, we are not a bank, so we don't have a lot of banking regulations.
But
deposit.
you're not a bank, but I'm gonna get to the note on note in a second.
Look, our credit committee has changed, but when you start comparing deals that we're presenting to credit committee, which obviously are few and far between than where they were a year or two ago, the metrics when you compare are almost, you hate to say it in this market, but like no brainer. So it's actually an easier credit committee because the deals you like and are presenting at the basis you think you're getting at and at the rates you're quoting at are significantly better than where we saw for the last 2-3 years. For us, for the stuff for the market we're playing.
With regard to that, let's talk about the note on note financing.
Sure. We've actually seen our leverage, because we lever almost all of our positions, more liquid now than it was a year or two ago. The banks or institutions that have provided us financing are still there. They've just moved accordingly with how the whole loan has moved. So
Are they all over there, including the signature?
we never borrowed from Signature.
Okay,
So
because
for us, ground up,
signature had the, note on note financing.
for us, ground up construction on the A note leverage side was never a deep bench. It was a 3 to 5 group regular process for us, and they're still there and active, and their core business is A note leverage financing as opposed to direct lending. So like, for example, the Axos banks of the world are as busy and active as ever in the space and are frankly looking at the opportunity now the same way we are. They can charge 100 basis points more on a project, and in their mind, nothing has really changed for park slope rents as an example.
Laura?
It actually goes back to what Danny was saying about could be perceived as slightly easier sometimes to go to credit committee because we are doing note on note financing, but the note on note financing we're doing today is at a basis, or the basis is just so low, and we're getting recourse and we're getting fabulous pricing. So they're deals that, I mean.
So how much leverage could he get on the deal?
So he can get, I mean, we're providing 50% and clients are okay with that. Sometimes it's maybe slightly above that, 60%.
Dan?
We love note on note. We've done a number of them. The problem with note on notes is they go away so damn quickly. You do a really nice deal with a great sponsor and it's a wonderful deal, and 9 months later, you're getting taken out. 14 months later, you're getting taken out. And you might make a little extra money because you put that into your deal that you get a minimum return. But the challenge with it's a lot of brain damage because it's all redevelopment and construction work. So it's a lot of work to get comfortable with it. And then you do the loan, and they're usually very strong underlying deals, and you're taken out of it too fast and you have to go find some more. So that's kind of the bigger challenge. But the coupons are great. The structures are great. They're booked as, they're not necessarily booked as CRE loans all the time. So it's a nice product with the right lead.
What about 5-year loans today? What's, permanent takeout loans? What's the status? You're not really in that
It's not my
business.
space.
That's not your space. What about you, Laura?
We're doing 5-year loans. People, the majority of our deals, more than the majority.
Are you doing takeout loans?
For takeout in terms of,
Permanent loans?
sure. But we're doing it at floating rates that are then hedged with swaps. So it's
So
attractive.
is there more hedging and swaps today?
There shouldn't be, but swaps were, if you did a bunch of swaps 2 years ago, you're an absolute hero right now as a bank, because you're getting, borrowers still paying 3.5 and you're earning 7. So it's a wonderful place to be. Logically, now should be the time, if the treasury curve tells us anything, we should be doing 5-year fixed rate deals. And if you lock that in at, pick a number 7%, you might be the hero in 3 years if rates start dropping and now you have a 450 basis point spread on a really nice property. But we all got kind of spoiled with swaps and everyone thinks it's the best thing since sliced bread, and it is. But right now, you know, if you had the nerve, you'd probably rather do some more fixed rate paper if the treasury curve tells us where rates are going to go.
Laura?
Right, but I think right now, clients are takers, right, of what banks are willing to provide. And so for us, right, we price accordingly. We haven't done a lot of fixed rate deals.
Okay. Danny, over the years, OceanFirst has bought certain banks. One of them was Country Bank.
Mhm.
And they always had an interesting portfolio, more of the Irish pubs and restaurants in the city of New York with a customer base. Are you still financing that type of business?
Yeah, it's a great little portfolio. Country Bank's book's about 550 million, and about a quarter of that is local business people that don't run a lot of bars, and not just Irish bars, all kind of bars, but they did really well. You know, the PPP was very good to them. They're very strong principals. We actually are financing right now 2 new acquisitions. Some of our existing guys are buying, investing, you know, it's the bar plus 6 above type of property. We continue to do that, and they're a great group of borrowers, and they perform and they keep good deposits. We love it.
Let's talk a little bit about retail, neighborhood retail, and as we heard before, Joe was talking about his conversion on retail and so on. What's the thoughts on retail, Dan?
Look, for what we do on the credit side, retail is never going to make or break the opportunity for us. So if the loan ever comes down to, well, they need to lease the retail at X for the deal to work in pencil, it's probably not for us. So on any given deal, and again, we're very much residential focused to piggyback off of the equity side of the business. We're never really focusing or relying on any type of retail enhancement for a deal to work, so.
Laura?
There's good retail and bad retail, right?
So what's good
And-
retail and what's bad retail?
Neighborhood retail, grocery anchored could be good retail, right? In fact, there was one deal we recently lost to insurance company. They were priced still really competitively. They were at 185.
180.
They were at 185. The difference that what we thought we had as a competitive advantage was the fact we're not going to have yield maintenance. We would have swap breakage.
Right.
But we still lost the deal. We can't compete at 185. So
No.
it's still a very viable market for specific neighborhood retail.
Dan?
Agree with everything she said. We like the grocery anchored, quality grocery anchored strips. There's some strips on Long Island we like a lot. There's the density in Long Island is tremendous, and in the right locations. We have a handful of those. The city's a little tougher, suburban, in Brooklyn, and there's some. I mean, it depends, right? That's what we get paid for. It depends. So not against it generically, but the further they get away from Amazon competition, you know, the more we like it.
What about the question of not neighborhood retail, on the gyms that are opening up today? I mean, as I was mentioning to the guys here before, Chelsea Piers is opening up a 90,000 square foot gym this weekend in Brooklyn. Okay, Lifetime Fitness over there. What's your thoughts about the gym and that market?
I don't hold, it's not a negative. Let me put it that way. There was a time when gym usage was kind of a negative. I don't think it's as much of a negative anymore. I think it's okay, but you know, you have to look at it and see who's operating it and stuff, but they're not thinning out. Some of the big ones had trouble obviously during COVID, LA Fitness and whatnot, but as a genre, it doesn't scare me anymore, but there was a time 3 or 4 years ago where our credit side would, you know, discount the gym tendency quite a bit. I don't think we do that quite as much anymore.
What about the pickleball business? Okay, you know, I believe they built the biggest pickleball in Westchester over there. They're converting I think it's the Lord and Taylor or something, and it's being gone into the pickleball. Is this vogue? Would you take a risk on a pickleball court?
First of all I have to say is pickleball is a fantastic sport.
Okay.
We don't finance pickleball courts or anything out of residential, but For some context, it's a fantastic sport.
Honestly, it's about concentration risk, right? You're gonna look at a center overall. If-
I mean, you know, you
I-
think going into criminal, I mean, years ago at IDB, there was a guy by the name of Kahana. And he was also known as Dr. No. Okay.
I think we've been Dr. Yes, frankly, for most of our clients in the past 9 to 12 months on the deals we're doing. We've been very active. But again, we're going to take a look at what's the concentration risk of a retail center or and take a look at what, maybe it's a small percentage of the income. So maybe yes, maybe no.
It beats empty, but I'm not giving them full boat credit for it. Put it that way.
So what's your fit? If somebody came to you and said, what's your ideal type of loan that you'd be looking at? What type of deals are you looking for? I think, Danny, you.
So we would be multifamily construction in the boroughs of New York that have significant equity invested in the deal, that the borrower has some time crunch sensitivity because of the looming 421A deadline. That would be our sweet spot down the fairway.
Laura?
We're looking at opportunity. So in the past 5 weeks, we have signed up multiple loans that are all over the place in terms of what they are, right? So multifamily construction, it's now really good pricing. I'm not saying we're doing this all the time, but we just signed up a land loan, but for a basis where it could work as a takeout for construction on multifamily market rate at full taxes. This is where we're talking about where when you get to a point where your basis is so low, these deals really do make sense. And if you can find a creative lender like us who says, wow, you can really make sense of this and we can get paid and get the right credit enhancements, that's interesting to us. So I think we're thinking outside the box. Industrial, we're doing ground up industrial, bridge industrial. So that's even some retail.
Dan?
I'm more of a cash flow guy. We do a lot of construction, but it's single family construction in Jersey and Delaware and Maryland where the demand is extraordinary. So we do quite a bit of that. We don't do a lot of construction up here because I can't get the numbers to work for our purposes. So we don't do much of that, but I love industrial. I love some of our existing customers are so strong. They're not, full leverage guys. To me, low leverage makes a lot of things pretty easy.
So listening to the conversation and following up from the first panel, one asset class that hasn't been really discussed is the office market.
The O word.
Okay, the old word. How do you look at the office market, especially older buildings, needs of improvement? How are you looking at any office space? Office properties? Danny? Dan?
We have, for existing clients, we've done some office. I love in the boroughs particularly, the relatively large buildings with 175 tenants. There's one of our customers has a couple of them and you cut our teeth with one, and there's a whole bunch of 800 square foot offices that people just want to be out of their home and they work, and the rent per square foot's high, but they're paying half of what they pay to rent their apartment 10 blocks away for their office space. So I kind of like that genre, and they're not leveraged that high, but for that and existing customers, not so much.
Laura?
So we would never say we are exiting a specific asset class or not, because there could be that diamond in the rough for a top client, top sponsor. So if it's perfect location, great tenancy, market rate, long-term leases, right? You get the picture. That makes a lot of sense. Office is clearly a challenged market, and hybrid and remote work has clearly affected that. And just to touch on that for one moment, it's funny, I think of diversity of being all different shapes and sizes. And right now to be able to tap into that specific workforce market who needs flexibility and can now work full-time because of hybrid and remote is a big win for all of us. And I know at IDB, we've been able to take advantage of that hybrid. We embrace hybrid. And because of that, we've attracted great talent.
What do you mean you've embraced hybrid?
We are a hybrid company.
Okay.
We are a hybrid company. So we do not require our staff, our employees to be in the office 5 days a week.
So someone said to me the other day, they were a signature borrower. 2 years ago, 3 years ago, if they had a signed lease with a new tenant, it didn't matter the quality, they were very happy to get a loan from Signature to build the improvements, the TI, the commissions and all this. Today, they said the doors are closed. What's your thought about that? Would you, to an existing client, it's one thing, and to a new client, it's another thing. Would you lend on that situation? Help me pay for my $150 a foot for improvements, help me pay for the brokerage commission, and so on.
No.
I think what makes it challenging is that when you look at, it depends how lowly leveraged the property is. I think you got to start with that.
But if they need
Right,
that money, you leverage it up.
Right, but so if you're looking at an office building that has tenant leases, right, that were signed even 2 to 4 years ago, we know that that's rolling down, right? So you have to take into consideration rolling, decreasing rents, increased vacancy, higher interest rates, and so it becomes challenged.
What about the conversions of office to residential? What's your thoughts about that?
I think it's a very challenging project. I think there are very few developers, you can probably name them on your hand, that have successfully done it. You know, I know on the equity side of the business, we've added a floor to some buildings and it's been a complete disaster. I think it's easier, it's good PR, but it's not a realistic solution.
Laura?
In my career, I have financed a conversion of a very big office to multifamily. What it takes is a developer with a lot of capital, because whatever the budget is, it probably ends up being 3 to 4 times the amount. I think usually people say twice the amount. In the end, it probably is a lot more. So I think if you go in knowing that, then perhaps it could make sense for a sponsor who really cares about making that change.
What about lending in emerging neighborhoods? You know, years ago, Williamsburg wasn't an emerging neighborhood, but today, you know, with the tenancies and everything over there, which neighborhoods, you know, you were talking before, something I think you have in Jersey City. These neighborhoods are doing well. How do you project what the future rents? I mean, you know, for the office and for the rental and so on, retail.
So we have a lot of exposure in Jersey City in multiple sub pockets there. We've thankfully done very well. And originally when we went there, Journal Square was not what it is today. So we've gotten lucky, quite frankly. But the reality is for these gentrifying neighborhoods is that you need a dearth of residential product to come online first, and the rest follows after. So you need to take a leap of faith on residential. And if you look at Journal Square right now, there's hundreds and thousands of units leased online and coming to market.
Correct.
And there's
Leased
not a single
online, that's the interesting.
not really a corridor to walk to, but that's, now that those residential projects have been successful and are there, those will come and follow, in our opinion.
Dan, especially since you've had that restaurant business.
Oh, that's great business, and it's, the cash flow is.
No, but
proven.
so do you reach yourself now into Jersey City, Hoboken, and other markets in the in that portion of the hospitality industry?
There are.
Or is
so-
it all relationship?
It's already, there's so many great opportunities that we don't have to go anywhere where we're not really comfortable with someone we know. There's just, particularly now, maybe 2 years ago it was different, but now there's just so many really strong opportunities out there to lend with really great sponsors, leverage, cash flow, that, you know, we're not looking for that extra 150, 200 basis point yield to go stretch somewhere where we're not comfortable.
Have you seen new banks or new entrees into the market? You're bringing Axios and other types.
We've seen a couple of new players in your note-on-note space, for sure. As it relates to direct competitors for kind of whole loan solutions, we haven't seen a new name.
What about?
Commercial banks is going the opposite direction, because when we're looking to do, call it a $150 million deal, and we can hold 50 million, we're looking for participants, and that pool of participants has decreased dramatically from 6 months ago to now.
So there are still
Less.
participants out there, but highly unlikely to,
I can count them on my hand.
are defined, and just competing on regular deals. Several of the very active players we all know about from a couple years ago, besides the ones that are no longer here, they're not playing right now either. So it certainly if you have the powder, it's certainly a lender's market right now. There's no question.
what about assisted living, aged communities? How do you look at that? Because the population is aging. Would you do any financing in that type of market? Independent living and assisted living and then memory care and so on.
The answer is yes. We haven't seen too much of it that is interesting. And I think, a theme that you're hearing now is, should we spec the time and resources to learn a new product type when there's such an opportunity in the stuff we can do all day long and that are straight down the fairway? So, it's not a no, but it's kind of like, is it a juicy enough one-off deal that makes sense from a time and resource allocation perspective to learn that market and demographics when I have a dearth of opportunities that I can, do in my sleep?
Right.
So I have a wonderful colleague, Michael Paul, who runs our healthcare group, and it depends on the specific deal.
Okay,
We
so
are
it's
open for
it's
business.
Considered healthcare as opposed to real estate.
Correct.
Healthcare.
At our bank, yes.
Healthcare is really an amazing place right now. You go over on the east side and look at what's going on over there and what has been built over there, and all as they said in the earlier panel, all the freestanding medical dialysis shops all over the boroughs and in the suburbs. I mean, that's hopefully not getting overbuilt like some of maybe the urgent cares did, but that's an incredible growth area.
What about the transit-oriented developments? What's your thoughts about that? Like they did in New Rochelle and Yonkers and the other sections like that.
And you're in that world.
We've done well in those environments. We believe in residential product in transit-oriented hubs. Journal Square, New Rochelle, we've done well. The pricing that we have now, interest rates and hard costs and no 421A, we have a long runway of no pipeline and supply coming to the market. So like anytime we're talking about doing a deal and we talk about units that are in development, we always talk about, well, for the next 3-4 years after that, there's going to be nothing. So we're very bullish on those types of opportunities.
What's your thoughts about lending on condominium developments?
In the right location and price point, we love it. So like Long Island City, we've done great. 1,100 a foot, $700,000 apartment. We don't do much in Manhattan because of that.
Laura?
So for the right sponsor, right now, again, because of the basis, condo happens to work. And for a while,
Even with the tax situation?
even with the tax situation, there actually aren't that many developments occurring. And so it's a handful that we've looked at and that we're now involved in, but again, for the right basis, it can work and you're getting paid for it.
Dan?
I just have a very hard time getting the math to work. The assumption on the takeout is just a little too rich for me to get comfortable. We don't do very much of that. Even the multifamily, we see so many multifamily construction jobs in Brooklyn, and then they're beautiful and they're up and they're leased and they're $60 a foot and $70 a foot sometimes, and they're an okay. You've got to bank on that maintaining for a long time. They're all 421A, so the rents can't go up any more than the government lets them go up. So I find that, and it costs so much to build them in the first place that the debt stack is pretty significant, and they want you to take out the entire debt stack.
Let's go out to that. What is the construction cost today for a new rental building?
A lot.
From us at the leverage points we're playing at, it's 600 and 700 over and up. And we're full stack, so we're going much higher than these guys are doing direct, but from our perspective.
It's unbelievable, but for pricing purposes, the 4 handle is the new 3 handle. So we actually can get 400 over on multifamily construction rental.
So as I would normally say on my show, I have the crystal apple over here. How do we look at the next 6 months or the next year? When are things going to be easier to get things done? When's the world going to readjust?
From a borrower's perspective, what I would recommend is, if your borrowers have a lot of money at the money center banks, if you want to develop a relationship with a bank, lead with deposits. You know, if you come into a bank like mine and you bring in deposits and you know you have a deal coming up, the banks are going to be much more open and flexible if you've already built a relationship. We get a lot of deals where they'll say, can you do a $10 million deal? We'll bring in $300,000 in deposits. That's not going to fly. But if you had already brought in a sizable amount of deposits and we have a relationship and you come in with a loan, I think that's the way people are going to get their deals financed. If they're not already in a bank that's very liquid and funding, I think you need people that don't have strong relationships now on the borrower side need to develop some with deposits, assuming they have them, versus putting them in a money center bank, because the banks will pay for deposits now. We all need deposits. So I would recommend that you do that. And I think that when you bring your deals in, I think banks will be much more open to, you know, giving you the pricing and the leverage and everything you're looking for.
Laura?
Dan's 100% right. Also, look, real estate, we go in cycles. So we can't bank on this to be lasting forever. So what I would say is that right now, as a commercial bank who is lending, we are executing, and speed and execution is what's getting us the deals to get them done right now.
It's not the old IDB, it's the new IDB.
It is, which is why we've hired, my staff has doubled in size. And not only that, I'm still looking for more underwriters, analysts, and potentially another relationship manager. I am busy. We are so busy. And we're taking advantage of this one point in time, because it's not necessarily going to be like this forever, I think, which is good for everyone, right? Not everyone wants it to be like this right now. But for us at the moment, we've been able to take advantage of it.
Benny?
Yeah, I mean, look, I keep referencing that post-COVID time was very similar to now. And there was a period of time, and no one knew how long it was, where you can have kind of deals on a silver platter for you. For the last 3 to 6 months, we've been focusing on bridge financing, which is take out of construction in addition to construction. That market has snapped back a little bit, where we could get a little more competitive and do some deals, and we did 2 of them, and now we just can't compete. So it's, you know, starting to snap back a little bit in some areas and some deal types and some product types. So do we know what's going to happen in 6 months? No, but, you know, as they said very eloquently, it's going to snap back at some point. It's a cycle. We're at the peak of it. So for groups like us who are active and looking to do stuff, the world's our oyster, but that will eventually come back.
So as I prefaced in the first panel with the developer saying to me, it's the best of times, it's the worst of times. I think there are opportunities out there. You have to take advantage of it. The banks have to work with the borrowers. The borrowers have to understand they're not sitting as key. Okay, he who has the money is the key. And I'd like to thank the 3 of you for being here. I'd like to thank the guests for participating and being here too. Thank you.